More now on the top story, specifically the government's changes to some trust funds and how this may impact families and businesses. Brent Murphy is a tax partner with KPMG and he joins us now from Sydney. Brent Murphy, welcome. So first of all, just what are discretionary trusts?
Hi, Joe. Yeah, discretionary trusts are trusts under which a trustee has the discretion as to where to pay the income from the trust each year. So it has a range of beneficiaries, usually various family members, and the trustee decides where to distribute the income each year.
Okay, so how have they generally been used up to now, and what have the tax rates been?
Yeah, so they're used in a range of circumstances. It can be used to hold passive wealth, and often, that's what the government's talking about with wealthy Australians holding assets in trust, and that's certainly common. Can also be used to run a small business because trusts are cheaper to set up than companies, and also provide a level of asset protection because the assets are owned by the trustee of the trust and not the individuals who are effectively running the business. And then it can be used as a business vehicle as well. Small businesses or trustee beneficiaries, beneficiaries of trusts are taxed at their marginal tax rates at the moment. And so just like any worker, if you earn a certain amount of income, then you'll pay tax based on marginal tax rates, whereas this new measure proposes to bring in a minimum of 30% tax on that income.
Yeah, and so to what degree will that change the rate under the new setup?
It will be a particular impost on those who are earning lower incomes. For higher income beneficiaries, they're probably already paying tax at the 30% rate, so it might not make much difference. But for those who are earning lower amounts of trust distributions, it may significantly increase the effective tax rate on the distributions that they receive.
And what's the difference between a discretionary trust and a fixed testamentary trust?
Yeah, so testamentary trusts are effectively a subset of trusts, and trusts can either be fixed or discretionary. So a discretionary testamentary trust is one where the testator gives the trustee discretion as to where they pay the income each year. And they're quite common because circumstances evolve over time, and these trusts are often set up for the long term and might benefit more than one generation. And at the time of death, you might not know what the personal circumstances are or even who the family members are. And so discretionary testamentary trusts are meant to cater for the changes in family circumstances that evolve over time and allow trustees to distribute income to those who most need it. Whereas a fixed trust is just that. It sets a fixed ratio of income that each beneficiary is entitled to receive, and the trustee doesn't have any discretion to depart from that. They're relatively uncommon in testamentary trusts because it's quite similar in many ways to gifting the assets to the beneficiaries themselves, which tends to be more common if you're looking to fix entitlements.
And so the government's planned changes are going to hit discretionary trusts and not fixed testamentary trusts.
That's right, Joe, yes.
Yeah. And so can you give us a basic example for regular, you've gone through all the financial language there around how all this works. Can you give us a really basic example of how a discretionary trust would work, say, within if there was a wealthy family and a parent was distributing money to children, say, how would that work?
Yeah, so at the moment, if the trust distributes money to children, and that's typically from earnings from investments in the trust, then that income is just taxed at the children's marginal tax rates. So the first 18,000 or so is tax-free, and then up to 45,000 taxed at about 15%. Under the proposals, that will change so that income is taxed at 30%. So up to 45,000, instead of about $4,000 tax, it'll be significantly more, about 13,500.
And so there are some people today saying that what the government is planning is a death tax. Do you agree with that kind of description?
I wouldn't go that far because ultimately this tax applies to trusts that are set up as testamentary trusts on someone's death, yes, but also they're set up for they will apply to any trusts that are set up during lifetime. And so it's a bit broader than that, but certainly it will result in testamentary trusts potentially paying a fair bit more tax than they currently do.
And so, as far as you're concerned, is the government's plan change fair enough? Will it achieve the government's desire of closing a loophole for wealthy people who might be avoiding reasonable tax obligations, or do you think they're barking up the wrong tree?
I think it's interesting because the papers that the government put out announcing these measures talked about distributions to children or the like, where the trustee holds on to the money. There's already rules that deal with that. I think practically the people who are most affected by this might be lower income earners who receive distributions, as opposed to the wealthy who are probably already paying tax at that top 30% or higher. So time will tell, but on the face of it, it seems that it might be those who are at the lower income levels who might be more disadvantaged. And we already have some rules that deal with situations where trustees purport to distribute to beneficiaries who don't actually receive the money. So you can't distribute to your children now and not giving them the benefit of that money.
So it doesn't seem to be, from what you're saying there, it doesn't seem to be achieving what the government actually wants.
Well, look, we'll see when we see the rules, but there are certainly cause for concern as to whether it will be effective. It certainly will change certain behaviours and will change potentially the way that that people structure their investments going forward.
Okay, Brent Murphy, thanks so much for having a chat to us from Sydney.
Pleasure. Thanks, Joe.